Hello everyone, this is Professor Kent. Today's recording is Income Tax Chapter 2, and today what we are going to do is we are going to be talking about procedures and administration. That's what we're going to be talking about. When we talk about CRA is Canada Revenue Agency. What is their mandate? What they do? They administrator tax. They pay the benefits and related programs. And they also want to ensure that the compliance on behalf of the government. So ensure compliance on behalf of the government. They are not a government, but they work behalf of the government. So then they also responsible, CRA is also responsible for administration for Income Tax Act and legislation related to CPP, Canada Pension Plan, and EI. So they are also responsible for that. When we talk about returns and payments from the individual perspective, in this situation that requires filing for an income tax. Again, if the CRA owes you money, you do not need to file your taxes. However, if you don't do it, there's some benefits that are dependent on it, so that they will stop those benefits if you don't file the taxes. So that's a situation that requires for filing. If you owe money, you have to file. If you're claiming a refund, of course you want the money from the government. Now, CRA demand to file means CRA demands you to file your return. You do it when you have to realize a gain. If you disposition of a capital property, if you're doing a pension income splitting, you have CPP and EI payable. If you're self-employed, any other eligible benefits you are allowed for could be child care benefits or any other GST or any benefit you are eligible for. You're not going to get it if you don't file your taxes. Now, there's a different way of filing taxes. So what the government came in, that is, there's something called free service. Normally, you have to pay the accountant to get your taxes done, but you have a free service. It starts on beginning of February. It always starts February 24th. 2024 in this case. If we were to do it for this year, if you're doing it next year, it will be starting February 24, 2025. And they said that's a free service, and that you have to file your return using that. So then what it does is allow eligible Canadians the opportunity to file their income tax return with a phone call. You call them and you file your taxes. And then this is called service to be expanded in summer. So in this current year that we're working on, this service was available to the taxpayer till September 2024. So they were allowed to do digital filing, or they were allowed to do a paper filing. So those were the purpose of the service is for the low or fixed income individual to file their return and receive a certain benefit, such as, like I said that before, child care tax benefit and Canadian carbon rebate tax that came in 2 years before. Now the individuals are allowed, they can file a paper, or they can do an e-file, or they can net file. When you're doing an e-file, is different from the net file. What net file is, it allows individual to file their own personal return directly on CRA online through the CRA certified tax software program. So they have a program. All you do is fill in the forms that applies to you. You could also e-file. If you have e-filing, you allows tax preparation service providers who have registered with their CRA to file their tax return. So if you are an accountant or you are not an accountant but you wanted to get, anybody can get an e-filer number, but you have to apply for an e-filer number, and then you could file your own return or you can file other people's return, but you needed to get their consent to file their return. The due date. So the due dates are important if you're filing your return. So if we are in January 1st to December 31st, 2024, you are going to be filing your return by April 30th, 2025. If you are a self-employed, you will be allowed to file your return by June 15 if you're self-employed. So if you're self-employed, you're allowed to file your return by June 15. However, if you owe them money, you needed to, I just wanted to bring you here, you needed to pay them by April 30th. Otherwise, you're going to pay the penalty and the interest. We're going to talk about a little bit later. So no extension to June 15 individuals with a business income. You have to file. If you owe them money, you have to give them money April 30th. But if somebody dies, so they can file their return 6 months after the date of the death, or whatever comes first, or if death occurs after October and before April 30th. So that's 6 months after the death, after the date of the death. So that's when you could file your return. So now this is also here to if the deceased person owes money, of course, then we call it estate filing. And then what it says that usually April 30th of the calendar year following the death, or 6 months extension if the death occurs between November 1st to April 30th. So what they do is they can file anything any time after the 6 month, but if they owe money, of course, sometimes they owe money, sometimes they don't owe money. Regardless of it, they have to file their return. It will be somebody who is responsible for their estate. Now, if due date for individuals, so again, under the ITA, Income Tax Act provides extended deadlines for filing to June 15th the following calendar year. The payments are due April 30th. This is if you're a sole proprietorship, that means you're self-employed or you're a member of a partnership. What you do is your due date of filing is June 15, but if you owe money, the payments are due on April 30th. Now, income tax withholding. There's 3 mandatory deductions if you did your accounting 1 and accounting 2. When we do payroll, there's 3 mandatory deductions when you work for an employer. Is CPP, EI, and income tax. These are the 3 mandatory deductions. The employer deducted from your pay and they submit those deductions to the CRA. So what happens, these deductions are called income tax withholding. So that's what it is called, income tax withholding. So what they do is every if you're getting paid twice a month, bi-weekly, then what the company does is they file their return, CPP and EI and income tax. They have to submit to the government behalf of you. Now, the employer also required by Income Tax Act, they said requires that any person making a payment described in ITA 152 must file an information return to the CRA. So when you, and I don't know if you're new to Canada, around February, March, we start getting T4s in the mail. So T4s, T4A, you get a pension statement, you get a retirement annuity, and other incomes that you generated. So you start getting it, and what you do is then you take it to the accountant if you don't want to do your own taxes, or you could use their e-file or net file to do the taxes if you're not making that much money. So now sometimes what happens is that if any year your net tax amount owing, next net tax owing means if you owe the government, the CRA, more than it's an installment threshold of 3,000. If you owe them more than 3,000, what you do is you needed to work out installment. You're required to make an installment so that it's easy for you to make the payments, installments. Otherwise you have to pay lump sum. So we calculate installment, and there's 3 alternatives to calculate it. There's alternative 1, alternative 2, alternative 3. So when we do that, current year, so you estimate the current year's net tax owing, and you make 4 installments. So whatever your tax owing is for the current year, you divide it by 4, and what you do is you make 4 installments. So you're going to be making 4 installments. That's your that's your alternative number 1. Your alternative number 2 is the actual net owing before the preceding year. So owing for the preceding year. So 1 before that, you divide it by 4 and you calculate your 4 installment. Or what you could do is you could do your first 2 payment is the actual net owing for the second preceding year divided by 4, and then whatever payment you made, you have to minus it and then divide it by the 2 payments that are left. Now this is all we're talking about, and now we need an example to calculate it. So when we do it, now we always say that CRA, when they calculate it, they always use alternative number 3 as their installment method. You don't have to make an installment. If you don't make an installment, you will be paying lump sum money. So now this is an example. So this is my current year, is my 2023. This is my first preceding year. This is my second preceding year, when we say that preceding year. So they said to calculate, first of all, we need, this is the net tax owing. As an individual, you owe 20,000 in 22, 32 in 23, you estimated it is going to be 24,000. First of all, if it's more than the 3,000, so if you owe more than 3,000 the last 2 years, the government CRA wants you to make an installment, and they want you to calculate. We're going to show you how to calculate it. So this is the example we're going to use. We're going to do alternative 1, alternative 2, then alternative number 3. So our first one is, you take alternative 1 is your current year. So what is my current year? Is 24,000. If I take 24,000 divided by 6, my 4 installment payment will be 6,000 each. 6 times the 4 is 2,400. That's alternative 1. Alternative 2 will be the preceding year, first preceding year, and then we take the second preceding year. This is my first preceding year, this is my second preceding year. I divided by the 4, my first, then my payments are 8,000 each. The payments are more here, so if you look at it, your payments are more. I'd rather take the alternative 1. That's when the payments are less. Now I'm going to go to alternative number 3. What they say that when you do that, your second preceding year divided by 4, your first 2 payment will be 5,000 each. So if it's a 5,000 each, you already made 2 payments. How did we get it? 5,000 times the 2, which is your $10,000. If in the 23 we owed $32,000, so then we go to my first preceding year, then 32 minus the 10, you're left with 22. 22,000 divided by 2 gives you 11,000. So you're going to make your 10,000 payment here, and then you're going to make your 22,000 payment here. Altogether we're making a 32,000 payments. That's what I mean. So you could have first preceding year, second preceding year, and this is how we calculate it. So what we wanted to do is, wherever we want our installment to be, wherever we're making less installment, that's the alternative we will be taking. But then when you think of it, if you don't want to make an installment, you do not need to make an installment. All you have to do is then make a lump sum payment in that current year. That's all you have to do. Now, if you do not pay on time and you owe the taxes, we owe the taxes, it's due on April 30th. Either you go to the, I'm going to talk about it later, how you make the payments. Even though your filing is June 15 for your self-employed person, you still, or sole proprietorship, you still have to file your tax. You could file your taxes till June 15, but any tax that you owe, you have to pay them by April 30th. So that's what you have to do. Otherwise, you have to pay the penalties. Now, penalties are very, very harsh. So if they are very harsh, again, we call something the base. What we do is, this is different from what we are talking about in this case. You have to pay interest on the money that you owe. That's what I wanted to say, that you owe the money. There's something that I wanted to talk about is prescribed interest rate. Prescribed interest rate apply to what? To shareholders loan. So as a shareholder, what you do is we call them a taxable benefit. When you prescribed interest rate is, you're getting a cheaper rate if the company gives you money. If the company gives you money, you're getting a cheaper rate. So what they do is, you could be paying no interest on the money that you borrowed from your company, but the government says that you need to use that as a taxable benefit. So in this case, what they're doing is, they said you have to use, even though the interest rate is higher, but you have to use something called prescribed interest rate that is given to you by the government CRA. For the first quarter, if the money that you borrow, you will be getting a taxable benefit of 4%. For the third and the fourth quarter, for the second, third, and the fourth quarter, you will be calculating the interest on the loan at the rate of 5%, and that becomes the taxable benefit. That becomes a taxable benefit. Now I'm just going to talk about this. This is more important. So what happens in this case, when you have, this is where the rates come from. The prescribed rate also comes from there too. If it's first quarter, you're going to pay them 4%. Second, third, and fourth quarter, you're going to pay them 5%. So if you owe money and you file late, so first, if this is your first offense, you're going to pay them 5% and then 1% per month, maximum of 12 months. So your penalty will be 17%. So this is if your first offense. If this is the second offense, your penalty increases. So penalty increases to 10%, and then you are allowed, they're not allowed, you pay 2% per month, maximum of 12 months. So that if I do it times the 2%, that gives you 40% plus the 10. You end up paying 50% on the money that if you don't file your taxes. So that's a lot of money. And then what we do is, top of the penalties, you are going to pay them the interest. So top of the penalties, you're going to pay them the interest, whatever the base rate is, plus the 4%. So whatever the base rate plus the 4%, that will be the interest that you're going to pay the CRA. So always good if you owe them money, to make a payment or make a lump sum payment so that they are happy. You don't have to make too much. You don't owe more than what your tax owing is. Now, when we think of returns and payments for the corporation, that was individual. Now we're talking about the corporation. So corporation can have any 12 months fiscal year, so or 53 weeks. But then what happens is that their filing deadline is 6 months after their tax year end. So what you could have a calendar year, or you could have any year as long it is 53 weeks. Soon as those 53 weeks are over, we have a deadline to file our taxes, which is 6 months after the year end. From the corporation, we call them T2, individual, we call it T1. So if your revenue, so the prescribed corporation must file their returns electronically. We used to do a paper filing. CRA does not accept any paper filings. We have to do electronically. So you need to get an e-filer, or your accountant will have an e-filer. He or she will be filing the return. And if it's a prescribed corporation, who are they? All corporation, if their revenue is more than 1 million, if it's more than 1 million, you should file your T2 electronically. Now, what else also prescribed? Who else are the prescribed corporations? The insurance corporation, the non-residence corporation that reports their income using functional currency, or a corporation exempt for Part 1. They should do a electronic filing. This for taxation year beginning 24, the 1 million gross revenue test will no longer apply. So the Income Tax Act changes all the time. The new rules are changes. So then the $1 million no longer apply to it. Used to be applied, but no longer applied for the year 2025. This is an example. Of course, if individuals are allowed to make installments, so is the corporation. So it's similar to what we do. So if first my current year, so this is divided by the monthly payment, my current year, my first preceding year, and then my second preceding year. So your alternative number 3 is similar to individuals. When you take it, what you're going to do is you're going to make your first two installment will be on the second preceding year. This is your first preceding year. So when you made the 2 payment, in this case we made 8,600 payments, we made 2 payments of it. That's how 116,000 came in 23. What you're going to do is we owed them 126. We are going to start making installment. Our installment will be 11,000 per month. Either I pay one monthly, or I pay one lump sum payment of what we owe to the government. Now, if you're a small CCPCs, private Canadian controlled private corporation, so in this case it's a private corporation, small CCPC, their taxable income does not exceed 500,000 during the current year. And then they also who they are taxable capital employed in Canada does not exceed the 10 million during the current year or previous year. So what happens in this case, when you're a small business, you get some deduction. We call them small business deduction, SBD. It changes every year. So small business deduction changes every year. If you own 2 corporations, this small business deduction will be shared between the 2 corporations, depending on who is at the who's owning it. So these, I don't know how this is here. So company is allowed to do monthly installments, or they can do it a quarterly installment. If they were if it's a bigger corporation, they will be allowed monthly, but if it's a smaller corporation, they will be allowed the alternative to make a quarterly payments. They no longer make the monthly, they make it quarterly payments. Again, it's similar to what we did. I hope there's an example. There's no example for it, so it is similar to what we did. Estimate the tax for the current year. So whatever my current year was 153. If that was the case, you will divide that by 4. Then the previous year's tax payable, you divide it by 4, whatever the payment is. Then what you're doing is you based on the second preceding year, and then divide it by 4, and then you minus it, your quarter 1 payment, and then the other one is divided by 3. So in this case, we don't make the 2 quarterly payments, we only make a 1 payment. So combination of both your second preceding year and the one before that. So that's previous year's payable. That's what you're gonna do. So normally what companies does it they have a choice of doing quarterly. If it's a small business, if it's a bigger corporation, they are allowed to do a monthly. Now when we think of a due date for the corporation, so of course we said that it's 6 months after the corporation's tax year they can file their taxes. Now if the due date for any remaining taxes owing within the 2 months of the corporation tax year, CC. Now what happens is that when you have any corporation, they owe taxes, we still have to pay the interest too on the penalties too. Now if it was a CCPC that meets the certain requirement, the due date is 3 months after the taxation year. So the due date is 3 months after the taxation's year end. So this is for the corporation, this is for CCPC. That's what it is, small business. So again, the penalties are a little bit less under the corporations. So it's saying same as individuals except the interest. So there's no base rate for the only difference is there's no base rate. All you're paying is 2%. That's what you're paying. And the late filing for large corporation is not much. It is it's 0.0005%. So it's not much if I were to think about it. Now returns and payment for the trust. So this is for the trust. You have 90 days after the taxation year end, which is usually calendar. Remember we said that, I don't know if you watch my video from chapter 1, the trust has filed T3 and they have a calendar year. And if they have a calendar year, they have a 90 days after their year end to file their return and to be filed, and the tax payable or made distribution. So what they do, trust does is after you make the payment, so if trust has money, you make the payments to the CRA, the leftover money is distributed to the beneficiary. So whoever the beneficiary of the trust is, could be the grandkids, could be a charity, could be anybody, depending on what is stated on the will, and that then it will be distributed. This is what it is. If you're part of the trust, you're getting some money because your grandparents were rich, maybe, or your godparents were rich. You are going to get an income, and that is called T3. And if you're going to get a T4 if you're working for an employer. If you have a lot of money and you invest that money, you could get a dividend, or you could get an interest. Then you're going to get T5. T4 SP is payment from the RRSP. If you contributed to RRSP plan and then now you're taking out the money, then you're going to get a T4, which you have to add it to your tax return. That's what you have to do. So now there's so many books and records that we have, so sometimes we cannot keep all the accounting records, but now it's easy because we have cloud. You could load it to the cloud. We have a lot of space, but sometimes we don't have a space. The rule is that you have to keep the filing for 6 years. After the 6 years, you could shred those filing. That's what you could do. Going further now, assessment and CRA of my account. So what you could do is, corporation is allowed to have a my account and individuals are allowed to have their my account too. So when we're doing individual, what you could do is autofill your return. That's one of the things you could do. You could access your RRSP, your notice of assessment. You could find out how much contribution limit you have for tax-free savings account. You can say you can see how much money you owe, how much installment you have to make. You could view the history. Means that if you requested to not have it paper filing, you're going to get you are going to get all the notices through the e-filing, e-paper. Then you have to go to my account and do it. If you want to know how much child care benefits you're getting, you could go to the my account and do it. Any e-notification will be given to you for if you owe money. Also, if you did not pay the payment and you had a good reason for not to make an installment payments or not to make a payment for your taxes, what we do is you could request for a relief for penalty and interest. You could just what we say is you have to have a good legit story that why didn't you file taxes on time and why did not make a payment. So you have to, that request is done through my filing. NOA is a notice of assessment. It is, you could get it from your my account. Why is it important? If you need a loan or if you're buying a house, you do need that notice of assessment to qualify for the loan. So provided so when you file your taxes, CRA is given to you by CRA. So it tells you how much money you owed, how much money you made, and what your refund is. That's what we're going to do. So this is again, this is your interest on refunds. So if you, of course, there's a penalty if you don't make if you owe the taxes, you have to give them the penalties. However, the same rule applies if they have to give you a refund. And if they have to give you a refund, they are going to take the base rate plus the 2%. Interest begins to accrue later of 30 days after return is filed, and the balance due date is April 30th. So what we're going to do after the 30 days, that's what you're going to get the interest from them. You can generate some interest from CRA too, but it's not as much they take from us. Same thing with the corporations. If they're going to get a refund, interest begins to accrue later of 120 days after the corporation year end and 30 days after the return is filed if it's filed after 120 days. Now we can make adjustment too. So if you file your return early and you didn't put in all the income, the government is going to reassess you. Or what you could do is you can change your return. You can change your return, or you could refile you can refile if you missed some information on your original return. Also, this is called reassessment of a return of an income. That's what it's called. sometimes you don't agree with Revenue Canada. We call them disputes and appeals, or they don't agree with something something you deducted. So let's say if you claim a tuition fees, and we normally don't give them the T2002 that you got from the college or from the university. When that happens, what you could do is they can ask you, okay, send us the backup information. If you don't do it, we're going to take away the deduction. So that's what happens. What happens is that you can communicate any disputes or appeals through the My account. So when you get a notice from CRA, what you have is you have 90 days from the date of notice of assessment to appeal for that dispute, or 1 year from the filing date for the year you are being assessed for. So that's what you have: 90 days from the date of an assessment, or 1 year from the filing. So for corporation and trust, they have a 90 days from the date of notice of assessment or notice of reassessment. When we think of a tax evasion, avoidance, and planning, so when you deliberately ignore specific part of Canada's tax law, you deliberately do that, you don't report any income, or you inflate the expense, you're deliberately doing that, of course it's a criminal offense. We shouldn't do that. You could be prosecuted, you could have a criminal record, and you have to pay the penalty equal to $200,000. Plus you could get 5 years in the jail. So that's called tax evasion. Avoidance, tax avoidance and planning is planning arrangement within a letter of, there's a law, you found the loophole, or you found out in the law that this applies to you. If it applies to you, then we call it tax planning. You could put money in the RRSP to reduce your taxes. You could have claim tuition fees to this is a planning. RRSP is a planning. So these so what we could do is avoidance and plannings are always good, because you can avoid paying taxes through the planning process. That's what it means. So the other part I wanted to say that was we call it a general anti-avoidance rule. The concept is, if you have any tax benefit, you needed to add it to your T4s. A tax avoidance transaction, you're out trying to avoid a transaction. If you put that into your return, you're going to pay taxes, or you can misuse or abuse the Income Tax Act. We call it a loophole. So sometimes there's a loophole there, and if everybody start taking advantage of it, government comes around to close that loophole. They're going to create another rule or law to create that loophole. So this was a little bit about tax payments. The most important question that is asked in there is how to calculate your installment payment, when your payments are due, and same thing with the corporations. The prescribed rate are given to you in the questions at the back of when we test you. Those are given to you. So prescribed rate, you don't have to memorize it. They're given to you by the CRA. Thank you so much for listening to me, and I will be recording the video for chapter 3 soon. Please don't forget to subscribe to my channel. I really appreciate if you send me some feedback so that I know what to change for the future. Thank you so much for listening to me. Take care and bye for now.